Welcome, welcome, welcome. All right. So today we are going to cover chapter 7 from the book Trading in the Zone. We have already covered 6 chapters in the past. In case you have missed any of them, please go through it to get a the better understanding of what exactly we are trying to do. Okay. And in case you are watching my video for the first time, so this is a small brief up that I have to give. That is basically we are covering a book by Sir Mark Douglas, which is Trading in the Zone, and it is very important for your psychology and especially if you are into trading, then it is very important for your trading psychology. Okay, so let's begin without any further ado. All right, so exactly what does it mean? Okay, first of all, the topic that we are going to cover today is the trader's edge, thinking in probabilities. Exactly what does it mean to think in probabilities and why it is so essential to one's consistent success as a trader. Probabilities plays a very vital role when it comes to success as a trader, right? Because whenever you're executing a trade, you need to understand either of the direction is possible. That means it can go in favor of your direction and can go against your direction as well. So you have to be ready for both of them. Okay, if you take a moment and analyze the last sentence, you'll notice that I made consistency a function of probabilities. It sounds like contradiction, right? Consistency and probabilities in real life, we think like they are kind of contradictory in nature. But here we are saying that for consistency, it is a function of probability from a mass market perspective, to be very precise. Okay, it sounds like a contradiction. How can someone produce consistent result from an event that has an uncertain probabilistic outcome? To answer this question, all we have to do is look to the gambling industry. Corporations spend vast amounts of money in the hundreds of billions, if not billion, or of dollars, and on elaborate hotels to attract people to their casinos. If you have been to Las Vegas, you know exactly what I'm talking about. Gaming corporations are just like other corporations in that they have to justify how they allocate their assets to board of directors and ultimately to their stockholders. How do you suppose they justify spending vast sum of money? Okay, just give me 1 second. I'm getting a call. All right, it is a spam call. Sorry for the inconvenience caused. Okay, moving ahead. If you have been to Las Vegas, you know exactly what I'm talking about. Gaming corporations are just like other corporations in that they have to justify how they allocate their assets to a board of directors and ultimately to their stockholders, right? How do you suppose they justify spending vast sum of monies on elaborate hotels and casinos whose primary function is to generate revenue from an event that has purely random outcome? Probabilities paradox, random outcome, consistent results. Here is an interesting paradox. Casinos make consistent profits day after day and year after year, facilitating an event that has a purely random outcome. At the same time, most traders believe that the outcome of the market's behavior is not random, yet can't seem to produce consistent profits. Shouldn't a consistent, non-random outcome produce consistent result, and a random outcome produce random, inconsistent results? What casino owners, experienced gamblers, and the best traders understand that the typical traders find difficult to grasp in, even that have probable outcomes can produce consistent results. If you can if you can get the odds in your favor and there is a large enough sample size, the best traders treat trading like a numbers game, right? Similar to the way in which casinos and professional gamblers approach gambling. To illustrate, let's look at the game of blackjack. In blackjack, the casinos have approximately a 4.5% edge over the player. Based on the rules they require players to adhere to, this means that over a large enough sample size number of hands placed, the casino will generate net profit of 4.5 cents on every dollar wagered on the game. This average of 4.5 cents take into account all the players who walked away big winners, including all winning streaks, all the players who walked away big losers, and everybody in between. So it is covering all of them, whoever is participating basically, right? At the end of the day, week, month, a year, the casino always ends up with approximately 4.5% of the total amount wagered. That 4.5% seems like might not sound like a lot, but let's put it in perspective. Suppose a total of $100 million is wagered collectively at all of casinos blackjack tables over the course of a year. The casino will net 4.5 million rupees. What casino owners and professional gamblers understand about the nature of probability is that each individual hand played is statistically independent of every other hand. This means that each individual hand is a unique event where the outcome is random relative to the last hand played on the or the next hand played. If you focus on each hand individually, there will be a random, unpredictable distribution between winning and losing hands. But on a collective basis, just the opposite is true. If a large enough number of hands is played, patterns will emerge that produce a consistent, predictable, and statistically reliable outcome. Here's what makes thinking in probability so difficult. It requires two layers of belief that on the surface seem to contradict each other. We'll call the first layer the micro level. At this level, you have to believe in the uncertainty and unpredictability of each individual hand. You know the truth of this uncertainty because there are always a number of unknown variables affecting the consistency of the deck that each new hand is drawn from. For example, you can't know in advance how any of the other participants will decide to play their hands, since they can either take or decline additional cards. Any variables acting on the consistency of the deck that can't be controlled or unknown in advance will make the outcome of any particular hand both uncertain and random, statistically independent in relationship to any other hand. The second layer is the macro level. At this level, you have to believe that the outcome over a series of hands played is relatively certain and predictable. So basically, at the micro level the things are uncertain, but at a macro level you'll see some consistency, you will see some predictability is what author is trying to say over here. Similarly, like in trading, like if you'll see an individual trader, like all the individual traders observes individually, then you will find out okay, they are, you know, not in sync, they are doing their own thing, and their result is also uncertain. But over a period of time, if we'll take a group of traders, you know, in a certain situation, you will find out there is this pattern, there is this, you know, some predictability that is present over here. And as a pro trader, all you have to do is pick out that for you and get the best profit out of it, right? The degree of certainty is based on the fixed or constant variables that are known in advance and specifically designed to give an advantage to one side or the other. The constant variables I am referring to as are the rules of the game. So even though you don't or couldn't know in advance unless you are psychic, the sequence of win to loses, you can be relatively certain that if enough hands are played, whoever has the edge will end up with more wins than loses. The degree of certainty is a function of how good the edge is. Okay, all right. I'm unable to copy it. Why? All right, let it be. Let's move ahead. Let's move ahead. My system is lagging a bit. I'll have to work on it. Okay, let's just skip the, you know, writing down the important parts. And whoever is watching it in video, you can stop and you can write down whatever you feel like is important to you. Understanding is important, and then you can make your own words in your own words as well. Right? You can make your own notes in your own words. All right, that's what I was trying to say. Okay. So from this example, you're not supposed to write down the exact example. Whatever you got from this example, whatever the essence you got from this example, you have to take that out and you have to take a note of it so that in future you can go through it. Okay. Or you can go through the video also. Now, it's the ability to believe in the unpredictability of the game at the micro level and simultaneously believe in the predictability of the game at the macro level that makes the casino and professional gamblers effective and successful at what they do. The belief in the uniqueness of each hand prevents them from engaging in the pointless endeavor of trying to predict the outcome of each individual hand. They have learned and completely accepted the fact that they don't know what's going to happen next. More important, they don't need to know in order to make money consistently because they don't have to know what's going to happen next. They don't place any special significance, emotional or otherwise, on each individual hand spin of the wheel or roll of the dice. In other words, they are not encumbered by unrealistic expectations about what is going to happen, nor are their egos involved in a way that makes them have to be right. As a result, it's easier to stay focused on keeping the odds in their favor and executing flawlessly, which in turn makes them less susceptible to making costly mistakes. They stay relaxed because they are committed and willing to let the probabilities play themselves out, all the while knowing that if their edge are good enough and the sample size are big enough, they will come out net winners. Right? The best traders use the same thinking strategy as the casino and professional gambler do. Not only does it work to their benefit, but the underlying dynamics supporting the need for such a strategy are exactly the same in trading as they are in gambling. A simple comparison between the two will demonstrate this quite clearly. Because the trader, the gambler, and the casino are all dealing with both known and unknown variables that affect the outcome of each trade or gambling event. In gambling, the known variables are the rules of the game. In trading, the known variables from each individual trader's perspective are the results of their market analysis. Market analysis finds behavior patterns in the collective actions of everyone participating in a market. We know that individual will act the same way under. Now, this is very important. Okay, so take a note of it, everyone. All right, just give me a sec. Okay, all I had to do was to scratch my nose. Okay, no worries. Now, I hope this is like you all already noted it down. We know that individual will act the same way under similar situation and circumstances over and over again, producing observable patterns of behavior. By the same token, group of individuals interacting with one another day after day, week after week, also produce behavior patterns that repeat themselves. These collective behavior patterns can be observed and discovered and identified with the help of analytical tools such as trend lines, moving average, oscillators, or retracement, just to name a few of thousands that are available to any trader. Each analytical tool uses a set of criteria to define the boundaries of each behavior pattern identified. The set of criteria and the boundaries identified are the trader's known market behavior, market variables. They are to the individual trader what the rules of the game are to the casino and player. Gambler. By this, I mean the trader's analytical tool are the known variable that put the odds of success, the edge for any given trade in the trader's favor. In the same way that the rules of the game puts the odd of success in favor of the casino. Second, we know that in gambling, a number of unknown variables act on the outcome of each game. In blackjack, the unknowns are the shuffling of the deck and how the players choose to play their hands. In craps, it's how the dice are thrown. And in roulette, it's the amount of force applied to spin the wheel. All these unknown variables. Okay, just wait a second. Okay, I'm getting this call once again. So, meanwhile, just go through the concept. And okay, spam people, they're like, I already disconnected their call multiple times and they are calling again and again. So, just to give them the clarity, I just picked up the call and said, I don't want to, deal with you right now. Hmm. In a polite way, in a polite manner, obviously, because I'm the kind of person who believes in kindness over anything. But at the same time, you have to keep your sanctity alive, right? So yeah, you need to be sane all the times. Hmm. Now, and in roulette, it's the amount of force applied to spin the wheel. All these unknown variables act as forces on the outcome of each individual event in a way that causes each event to be statistically independent of any other individual event, thereby creating a random distribution between wins and losses. Trading also involves a number of unknown variables that act on the outcome of any particular behavior pattern a trader may identify and use as his edge. In trading, the unknown variables are all other traders who have the potential to come into the market to put on or take off a trade. Each trade contributes to the market's position at any given moment, which means that each trader acting on a belief about what is high and what is low contributes to the collective behavior pattern that is displayed at the moment. If there is a recognizable pattern, and if the variables used to define that pattern conform to a particular trader's definition of an edge, then we can say that the market is offering the trader an opportunity to buy low or sell high based on trader's definition. Suppose a trader seizes the opportunity to take advantage of his edge and puts on a trade. What factors will determine whether the market unfolds in the direction of his edge or against it? The answer is the behavior of other traders. At the moment, he puts this is very important, okay? When you are entered, then all you have to see the other traders are also interested in the same direction or not. Okay, if they are attracted to the same direction at the same moment, then you will see the price getting high and in your favor as an option buyer, I'm talking about. Okay, but if that's not the case, you'll see the market is getting, in between some range, or it is coming down slowly. So then you have to understand and you have to accept that, okay, the thought, the chance that the risk that you took is not acting the way you thought it would act, or it would work. So now you have to do, you have to cut short your losses. Okay, so that's why we are putting on predefined SL should also be logical. Okay, it shouldn't be like random. All right, now, moving ahead, suppose, and if variables used to do, okay. Each trade contributes to the market's position at any given moment, which means that each trader acting on a belief about what is high and what is low contributes to the collective behavior pattern that is displayed at that moment. If there is a recognizable pattern, and if the variables used to define that pattern conform to a particular trader's definition of an edge, then we can say that the market is offering the trader an opportunity to buy low or sell high. Okay, can I copy it now? Okay, now I can copy it. All right. Let's see if I can paste it as well. Hopefully, yes. Yes. Okay, let's go back. Based on the trader's definition, suppose the trader seizes the opportunity to take advantage of his edge and puts on a trade. What favors will determine whether the market unfolds in the direction of his edge or against it? The answer is the behavior of other traders. At the moment, he puts on a trade, and for as long, it is very important. We all know about it, but when we were in the trading, or like when we are actually trading, no, at the time we just ignore this very fact, and that's why I'm taking a note of it, even though it is a universal fact. But still, we chose to, ignore it, and we chose to go ahead with some other logic, and focusing on the candle and the charts rather than finding out what other people are thinking at the moment. Because if it will go in your direction or not, it is decided by the other traders only, right? And you can see that with the help of chart, with the help of the trend and everything else. At the moment, he puts on a trade, and for as long as he chooses to stay in the trade, other traders will be participating in that market. They will be acting on their beliefs about what is high and what is low. At any given point, some percentage of other traders will contribute to an outcome favorable to our trader's edge, and the participation of some percentage of traders will negate his edge. There's no way to know in advance how everyone else is going to behave and how their behavior will affect his trade. So the outcome of the trade is uncertain. The fact is, the outcome of every legal trade that anyone decides to make is affected in some way by the subsequent behavior of other traders participating in the market, making the outcome of all traders uncertain. Right. Hmm. Since all traders have an uncertain outcome, then like gambling, each trader has to be statistically independent of the next trade, the last trade, or any trades in the future. Even though the trader may use the same set of known variables to identify his edge for each trade, furthermore, if the outcome of each individual trade is statistically independent of every other trade, there must also be a random distribution between wins and losses in any given string or set of trades, even though the odds of success for each individual trader may be in the trader's favor. Third, casino owners don't try to predict or know in advance the outcome of each individual event. Aside from the fact that it would be extremely difficult given all the unknown variables operating in each game, it isn't necessary to create consistent results. Casino operators have learned that all they have to do is keep the odds in their favor and have a large enough sample size of events so that their edges have ample opportunity to work. Right. Trading in the moment. Traders who have learned to think in probabilities approach the markets from virtually the same perspective. At the micro level, they believe that each trade or edge is unique. What they understand about the nature of trading is that at any given moment, the market may look exactly the same on a chart as it did at some previous moment, and the geometric measurements and mathematical calculation used to determine each edge can be exactly the same from one edge to the next, but the actual consistency of the market itself from one moment to the next is never the same. For any particular pattern to be exactly the same now as it was in some previous moment would require that every trader who participated in that previous moment be present. Okay, this is very important, right? Hmm. And that's not the case, right? So last time you saw some pattern, it is just giving you a normal direction and normal, what I can say, observation. What's more, each of them would have also have to interact with one another in exactly the same way over some period of time to produce the exact same outcome to whatever pattern was being observed. The odds of that happening are non-existent. It is extremely important that you understand this phenomena because the psychological implication for your trading couldn't be more important. We can use all the various tools to analyze the market's behavior and find the patterns that represent the best edges. And from an analytical perspective, these patterns can appear to be precisely the same in every respect, both mathematically and visually. But if the consistency of the group of traders who are creating the pattern now is represented by even one person from the group that created the pattern in past, then the outcome of the current pattern has the potential to be different from the past pattern. Important, important. Hmm. Right. The example of the analyst and chairman illustrates this point of it quite well. It takes only one trader, somewhat in the word, with a different belief about the future to change the outcome of any particular market pattern and negate the edge that pattern represents. The example that they are talking about, we have covered it in the sixth chapter. So in case if you have missed it, please go through it to understand the better context of it. Okay. The most fundamental characteristics of with a different belief. All right. It takes only one trader somewhere in the world with a different belief about the future to change the outcome of any particular market pattern and negate the edge that pattern represents. The most fundamental characteristics of the market's behavior is that each now moment market situation, each now moment behavior pattern. Okay. And each now moment edge is always a unique occurrence with its own outcome independent of all the others. Let me add text box. If you guys are wondering what I'm doing in between, I'm, making a PPD out of the important facts or whatever important I'm finding that is worth writing down. So I'm just, copy pasting that stuff in a different PPD altogether. Uniqueness implies that everything can happen, either what we know, accept or anticipate, or what we don't know or can't know unless we had extraordinary perceptual abilities. A constant flow of both known and unknown variables creates a probabilistic environment where we don't know for certain what will happen next. This last sentence or statement may seem quite logical, right? A constant flow of both known and unknown variables create a probabilistic environment where we don't know for certain what will happen next. Change is the only constant in the life and in market also. So this last statement may seem quite logical, even self-evident, but there is a huge problem here that is anything but logical or self-evident. Being aware of uncertainty and understanding the nature of probabilities does not equate with the inability to actually function effectively from a probabilistic perspective. Thinking in probabilities can be difficult to master because our minds don't naturally process information in this manner. Quite the contrary, our minds cause us to perceive what we know, and what we know is a part of our past, whereas in the market, every moment is a new and unique, even though there may be similarities to something that occurred in the past. Okay? Hmm. All right. This means that unless we train our minds to perceive the uniqueness of each moment, that uniqueness will automatically be filtered out of our perception. We'll perceive only what we know, minus any information that is blocked by our fears. Everything else will remain invisible. Right. So that's why there is a need to change it. The bottom line is that there is some degree of sophistication to thinking in probabilities, which can take some people a considerable amount of effort to integrate into their mental systems as a functional thinking strategy. All right. Most traders don't fully understand this. As a result, they mistakenly assume they are thinking in probabilities because they have some degree of understanding of the concepts. I've worked with hundreds of traders who mistakenly assumed they thought in probabilities but didn't. Here is an example of a trader I worked with whom I'll call Bob. Bob is a certified trading advisor, CTA, who manages approximately 50 million in investments. He's been in the business for almost 30 years. He came to one of my workshop because he was never able to produce more than 12 to 18% annual return on the accounts he managed. This was an adequate return, but Bob was extremely dissatisfied because his analytical ability suggested that he should be achieving an annual return of 150 to 200%. I would describe Bob as being well versed in the nature of probabilities. In other words, he understood the concept, but he didn't function from a probabilistic perspective. Shortly after attending the workshop, he called to ask me for some advice. Here's the entry from my journal written immediately after the phone conversation. 9/28/95. Bob called with a problem. He put on a belly trade and put his stop in the market. The market traded about a third of the way to his stop and then went back to his entry point where he decided to bail out of the trade. Almost immediately after he got out, the bellies went 500 points in the direction of his trade. But of course, he was out of the market. He didn't understand what was going on. First, I asked him what was at risk. He didn't understand the question. He assumed that he had accepted the risk because he put in a stop. I responded that just because he put in a stop, it doesn't mean that he had truly accepted the risk of the trade. There are many things that can be at risk: losing money, being wrong, not being perfect, depending on one's underlying motivation for trading. I pointed out that a person's beliefs are always revealed by their actions. Person's beliefs are always revealed by their actions. So in the previous chapters, we have already learned, no, market just reflect your perspective. So that's what we meant over there. We can assume that he was operating out of belief that to be a disciplined trader, one has to define a risk and put a stop in. And so he did. But a person can put in a stop and at the same time not believe that he is going to be stopped out or that the trade will ever work against him. For that matter, by the way he described the situation, it sounded to me as if this is exactly what happened to him. When he put on the trade, he didn't believe he would be stopped out, nor did he believe the market would trade against him. In fact, he was so adamant about this that when the market came back to his entry point, he got out of the trade to punish the market with it with an "I'll show you" attitude for even going against him by one tick. After I pointed this out to him, he said this was exactly the attitude he had when he took off the trade. He said that he had been waiting for his particular trade for weeks, and when the market has finally got to this point, he thought it would immediately reverse. I responded by reminding him to look at the experience as simply pointing the way to thinking that he needs to learn. A prerequisite for thinking is in probability is that you accept the risk, because if you don't, you'll not want to face the possibilities that you haven't accepted if and when they do present themselves. So that's also what happened to me. Like I have decided an SL, and it was an logical SL, but because of the account size that I have, I was not able to accept. So that's why when the market already decided to take my SL and you know, the loss I have decided for the day, I was like, I'll recover it. I was not just accepting, and I was trying again and again, and I was not following the rules and stuff. And ultimately, I was closing my day even with more loss. So that's what happened to me. That's my biggest problem that I have to cater, man. So that is very, very, very important. As a trader, you need to accept the risk. So that means when you're putting on a SL, that means if that much money will be gone, you are completely fine with it. You have to accept it. Okay. That is the meaning of SL. It shouldn't be like you have put on an SL just for the sake of putting on an SL. And if it will be taken by you, taken from you, you'll feel the hella, what I can say, it will affect your psychology in wrong manner and stuff. It shouldn't be like that. When you have trained your mind to think in probabilities, it means you have fully accepted all the possibilities with no internal resistance or conflict, and you always do something to take the unknown forces into account. That is very important. So you have to accept all the probabilities with whole heart, and that includes the probability of getting wrong and losing in a trade as well. And now I'm like, that's why people find it very difficult, right? Okay, just let me add another text box. I'm writing these things down as well. In case if you feel like I should share this with you as well, so just let me know. I'll put it in the description from next time onwards. Okay, like the notes of this will be in the description of the next video for obvious reasons, because I am creating it during making the video, like when I'm making the video only, right? Thinking this way is virtually impossible unless you have done the mental work necessary to let go of the need to know what is going to happen next, or the need to be right on each trade. In fact, the degree by which you think you know, assume you know, or in any way need to know what is going to happen next is equal to the degree of which you will fail as a trader. All right. So that is what you need to understand. Traders who have learned to think in probabilities are confident of their overall success because they commit themselves to taking every trade that conforms to their definition of an edge. They don't attempt to pick and choose the edge they think, assume, or believe they are going to work and act on those. Nor do they avoid the edges that, for whatever reason, they think, assume, or believe they aren't going to work. If they did either of those things, they would be contradicting their belief that the now moment situation is always unique, creating a random distribution between wins and losses on any given string of edges. They have learned, usually quite painfully, that they don't know in advance which edges are going to work and which ones aren't. Okay. They have stopped trying to predict outcomes. They have found that by taking every edge, they correspondingly increase their sample size of trades, which in turn gives whatever edge they use ample opportunity to play itself in their behavior. Just like the casinos. On the other hand, what do you think unsuccessful traders are observed obsessed traders are obsessed with market analysis. They crave the sense of certainty that analysis appears to give them that analysis appears to give them. Although few would admit it, the truth is that the typical trader wants to be right on every single trade. He's desperately trying to create certainty where it just doesn't exist. Hmm. The irony is that if he completely accepted the fact that certainty doesn't exist, he would create the certainty he craves. Very big statement. He would be absolutely certain that the certainty doesn't exist. Okay. All right. If you understood this, then you understood the crux of this chapter, right? The irony is that if he, that means an unsuccessful trader, completely accepted the fact that certainty doesn't exist, he would create the certainty he craves. He would be absolutely certain that certainty doesn't exist. Okay. All right. When you achieve complete acceptance of the uncertainty of each edge and the uniqueness of each moment, your frustration with trading will end. Right. Because nothing to prove, right? You're just accepting the rules. You're just accepting the game the way it is supposed to be played. Furthermore, you'll no longer be susceptible to making all the typical trading errors that detract from your potential to be consistent and destroy your sense of self confidence. Now, this is very, very, very important. I'll take a note of it because this is like one of the solutions that is provided over here. No, so I'll just change the font size and I'll. Okay. For example, not taking the risk before into a trade is have okay, and start the whole process of trading from an inappropriate perspective. In light of the fact that anything can happen, wouldn't it make perfect sense to decide before executing a trade that the market has to look, sound, or feel like to tell you your age isn't working? So why doesn't the typical trader decide to do it or do it every single time? I've already given you the answer in the last chapter, but there's more to it, and there's also some tricky logic involved. But the answer is simple. The typical trader won't predefine the risk of getting into a trade because he doesn't believe it's necessary. The only way he could believe it isn't necessary is if he believes he knows what's going to happen next. The reason he believes he knows what's going to happen next is because he won't get into a trade until he's convinced that he's right. At the point where he's convinced the trade will be a winner, it's no longer necessary to define the risk because of his right. There's no risk. Typical traders go through the exercise of convincing themselves that they're right before they get into a trade because the alternative, being wrong, is simply unacceptable. Remember that our minds are wired to associate. Okay, let me add another text box in another slide. Okay, so in between when I'm doing it, so if you want, you can skip or you can just read the content on on the screen by yourself, right? So in either way, it is a win-win for you guys. Okay, as a result, being wrong on any given trade has the potential to be associated with any or every other experience in a trader's life he's been wrong. Very important. As a result, being wrong on any given trade has the potential to be associated with any or other experience in a trader's life where he was wrong. So, in our life, we have a lot of failures, right? And it builds our belief systems. So, when you are in a trade and you are thinking that, okay, it is going to be a winner, so you are not placing an SL into it. And then when the market is going against you, you're not ready to accept that okay, you are wrong, because it will associate with all the times you have been wrong in your life, and then you'll feel the pain, and you as a human being, we don't want to feel that pain, right? To ignore it and to just, get rid of it. What we do, we don't take the first step, we don't put the SL, but that's so wrong, because ultimately it is going to give us more pain. The implication is that any trade can easily tap him into the accumulated pain of every time he has been wrong in his life. Given the huge backlog of unresolved negative energy surrounding that it means to be wrong that exists in most people, it's easy to see why each and every trade can literally take on the significance of a life or a death situation. So for the typical trader, determining what the market would have to look, sound, or feel like to tell him that trade isn't working would create an irreconcilable, uh, irreconcilable dilemma. Okay, on one hand, he desperately wants to win, and the only way he can do that is to participate. But the only way he will participate is if he's sure the trade will win. On the other hand, if he defines his risk, he's willfully gathering evidence that would negate something he has already convinced himself of. He'll be contradicting the decision making process he went through to convince himself that the trade will work. If he exposed himself to conflicting information, it would surely create some degree of doubt about the viability of that trade. If he allows himself to experience doubt, it's very likely he will participate. It's very unlikely he will participate. If he doesn't put the trade on and it turns out to be a winner, he'll be in extreme agony. For some people, nothing hurts more than an opportunity or recognized but missed because of self doubt. For the typical trader, the only way out of his psychological dilemma is to ignore the risk and remain convinced that the trade is right. If any of this sounds familiar, consider this. When you're convincing yourself that you're right, what you're saying to yourself is, I know who's in this market and who's about to come into the market. I know what they believe about what is high or what is low. Furthermore, I know each individual's capacity to act on those beliefs, the degree of clarity or relative lack of inner conflict. And with this knowledge, I'm able to determine how the actions of each of these individuals will affect price movement in its collective form a second, a minute, an hour, a day, or a week from now. Looking at the process of convincing yourself that you are right from this perspective, it seems a bit absurd, doesn't fit. For the traders who have learned to think in probabilities, there is no dilemma. Predefining the risk doesn't pose a problem for those traders because they don't trade from a right or wrong perspective. They have learned that trading doesn't have anything to do with being right or wrong on any individual trade. As a result, they don't perceive the risk of trading in the same way the typical trader does. Any of the best traders, the probability thinkers, could have just as much negative energy surrounding what it means to be wrong as a typical trader. But as long as they legitimately define trading as a probability game, their emotional response to the outcome of any particular trade are equivalent to how the typical trader would feel about flipping a coin, calling heads and seeing the coin come up tails. A wrong call, but for most people, being wrong about predicting the flip of a coin would not tap them into the accumulated pain of every other time in their lives they have they had been wrong. Why? Most people know that the outcome of a coin toss is random. If you believe the outcome is random, then you naturally expect a random outcome. Randomness implies at least some degree of uncertainty. So when we believe in a random outcome, there is an implied acceptance that we don't know what the outcome will be. When we accept in advance of an event that we don't know how it will turn out, that acceptance has the effect of keeping our expectations neutral and open ended. Now, we are getting down to the very core of what ails the typical trader, an expectation about the market's behavior that is specific, well defined, or rigid instead of being neutral and open ended is unrealistic and potentially damaging. I define an unrealistic expectation as one that does not correspond with the possibility available from the market's perspective. If each moment in the market is unique and anything is possible, then any expectation that does not reflect these boundaryless characteristics is unrealistic. Managing expectations. The potential damage caused by holding unrealistic expectation comes from how it affects the way we perceive information. Expectations are mental represent the potential damage caused by holding unrealistic expectation come from how it affects the way we perceive information. Expectations are mental representation of what some future moment will look, sound, taste, smell, or feel like. Expectation come from what we know. This makes sense because we can't expect something that we have no knowledge or awareness of. What we know is synonymous with what we have learned to believe about the ways in which the external environment can express itself. What we believe is our own personal version of the truth. What we expect something, when we expect something, we are projecting out into the future what we believe to be true. Okay. We are expecting the outside environment a minute, an hour, a day, a week, or a month from now to be the way we have represented it in our minds. We have to be careful about what we project out into the future because nothing else has the potential to create more unhappiness and emotional misery than an unfulfilled expectation. When things happen exactly as you expect them to, how do you feel? The response is generally wonderful, including feelings like happiness, joy, satisfaction, and a greater sense of well being, unless, of course, you were expecting something dreadful and it manifested itself. Conversely, how do you feel when your expectations are not fulfilled? The universal response is emotional pain. Hmm. Everyone experiences some degree of anger, resentment, despair, regret, disappointment, dissatisfaction, or betrayal when the environment doesn't turn out to be exactly as we expected it to be. Unless, of course, we are completely surprised by something much better than we imagined. Here's where we run into problems because our expectations come from what we know. When we decide or believe that we know something, we naturally expect to be right. At that point, we are no longer in a neutral or open state of mind, and it's not difficult to understand why. If we are going to feel great, if the market does what we expect it to do, if we are going to feel great in this case, right, or feel horrible if it doesn't, then we are not exactly neutral or open minded. Quite the contrary. Okay, let me take a note of it. Quite the contrary, the force of the belief behind the expectations will cause us to perceive market information in a way that confirms what we expect. We naturally feel like feeling good, and our pain avoidance mechanism will shield us from information that doesn't confirm that we expect to keep us from feeling bad. As I have already indicated, our minds are designed to help us avoid pain, both physical and emotional. These pain avoidance mechanisms exist at both conscious and subconscious level. For example, if an object is coming toward your head, you react instinctively to get out of the way. Ducking does not uh, ducking does not require a conscious decision making process. On the other hand, if you clearly see the object and have time to consider the alternatives, you may decide to catch the object, bat it away with your hand, or duck. These are examples of how we protect ourselves from physical pain. Okay. Hmm. Protecting ourselves from emotional or mental pain works in the same way, except that we are now protecting ourselves from information. For example, the market expresses information about itself and its potential to move in a particular direction. If there is a difference between what we want or expect and what the market is offering or making available, then our pain avoidance mechanism kicks in to compensate for the differences. As with physical pain, these mechanisms operate at both the conscious and subconscious level. To protect ourselves from painful information at the conscious level, we rationalize, justify, make excuses, willfully gather information that will neutralize the significance of the conflicting information, get angry to ward off the conflicting information, or just plain lie to ourselves. At the conscious level, that's what we are doing. At the subconscious level, the pain avoidance process is much more subtle and mysterious. At this level, our minds may block our ability to see other alternatives, even though in other circumstances we would be able to perceive them. Now, because they are in conflict with what we want or expect, our pain avoidance mechanism can make them disappear as if they didn't exist. To illustrate this phenomena, the best example is one I have already given you. We are in a trade where the market is moving against us. In fact, the market has established a trend in the opposite direction to what we want or expect. Ordinarily, we would have no problem identifying or perceiving this pattern if it weren't for the fact that the market was going against our position, but the pattern loses its significance, becomes invisible because we find it too painful to acknowledge. To avoid the pain, we narrow our focus or attention and concentrate on information that keeps us out of pain, regardless of how insignificant or minute. In the meantime, the information that clearly indicates the presence of a trend and the opportunity to trade in the direction of the trend becomes invisible. The trend doesn't disappear from physical reality, but our ability to perceive it does. Our pain avoidance mechanism block our ability to define and interpret what the market is doing as a trend. The trend will then stay invisible until the market either reverses in our favor or we are forced out of the trade because the pressure of losing too much money becomes unbearable. It's not until we are either out of the trade or out of the danger that the trend becomes apparent, as well as all the opportunities to make money by trading in the trade also comes back in. Okay. All right. Okay, what happened? Have I switched the windows? Man, oh man. Okay. The trend will then stay invisible until the okay, we have already covered this one, right? All the distinction that would otherwise be perceivable become perfectly clear after the fact when there is no longer anything from our for our minds to protect us from. We all have the potential to engage in self-protective pain avoidance mechanism because they are neutral functions of the way our minds operate. There may be times when we are protecting ourselves from information that has potential to bring up deep seated emotional wounds or traumas that we are just not ready to face or don't have the appropriate skills or resources to deal with. In these cases, our natural mechanisms are serving us well, but more often, our pain avoidance mechanisms are just protecting us from information that would indicate that our expectation do not correspond with what is available from the environment's perspective. This is where our pain avoidance mechanism do us a disservice, especially as traders. To understand this concept, ask yourself what exactly about the market information is threatening. Is it threatening because the market actually expresses negatively charged information as an inherent characteristic of the way it exists? It may seem that way, but at the most fundamental level, what the market gives us to perceive are upticks and downticks or up bars and down bars. These up and down ticks form patterns that represent edges. Now, are any of these ticks or the patterns they form negatively charged? They form negatively charged? No. Again, it may certainly seem that way, but from the market's perspective, the information is neutral. Each tick, down tick, each up tick. Okay, let me take a note of it, then we'll continue. Let me add another slide. Hmm. Each uptick, downtick, or pattern is just information telling us the market's position. If any of this information has had a negative charge as an inherent characteristics of the way it exists, then wouldn't everyone exposed to it experience emotional pain? For example, if both you and I get hit on the head with a solid object, there probably wouldn't be much difference in how we would feel. We'd both be in pain. Any part of the any part of our bodies coming into contact with a solid object with some degree of force will cause anyone with a normal nervous system to experience the pain. We share the experience because our bodies are constructed in basically the same way. The pain is an automatic psychological response to the impact with a tangible object. Information is the form of words or gestures expressed by the environments, or up and down ticks expressed by the markers, or can be just as painful as being hit with a solid object. But there is an important difference between information and objects. Information is not tangible. Information doesn't consist of atoms and molecules. To experience the potential effects of information, whether negative or positive, requires an interpretation. The interpretation we make are function of our mental unique mental framework. Everyone's mental framework is unique for two fundamental reasons. First, all of us were born with different genetically coded behavior and personality characteristics that causes us to have different needs from one another. How positively or negatively and to what degree the environment responds to these needs creates experiences unique to each individual. Second, everyone is exposed to a variety of environmental forces. Some of these forces are similar from one individual to the next, but none are exactly the same. If you consider the number of possible combination of genetically encoded personality characteristics we can be born with in relation to the almost infinite variety of environmental forces we can encounter throughout our lives, all of which contribute to the construction of our mental framework, then it's not difficult to see why there is no universal mental framework common to everyone. Unlike our bodies, which have a common molecular structure that experiences physical pain, there is no universe mindset to assure us that we'll share the potential negative or positive effects of information in the same way. For example, someone would be projecting insults at you, intending to cause you to feel emotional pain. From the environment's perspective, this is negatively charged information. Will you experience the intended negative effects? Not necessarily. You have to be able to interpret the information as negative to experience it as negative. But if this person is insulting you in a language that you don't understand, or it is using words you don't know the meaning of, would you feel the intended pain? Not until you build a framework to define and understand the word is in a derogatory manner. Even then, we can't assume that what you feel would correspond to the intent behind the insult. You could have a framework to perceive the negative intent, but instead of feeling pain, you might experience perverse type of pleasure. I've encountered many people who simply, for their own amusement, like to get people riled up with negative emotions. Okay, yeah, so that's very common. Making fun of someone else, like among friends. I'm not talking about bullying, but you know, when we are trying to have fun with our friends and we are trying to push the buttons of that person, and then he'll get riled up, and then we'll feel good about it, right? So among friends, I have also done it. So yeah, culprit right here. If they happen to be insulted in the process, it creates a sense of joy because then they know how successful they have been. A person expressing genuine love is projecting positively charged information into the environment. Let's say the intent behind the expression of these positive feelings is to convey affection, endearment, and friendship. Are there any assurance that a person or persons this positively charged information is being projected toward will interpret and experience it as such? No, there aren't. A person with a very low sense of self-esteem, or someone who experienced a great deal of hurt and disappointment in relationship, will often misinterpret an expression of genuine love as something else. In the case of a person with self-esteem, if he doesn't believe he deserves to be loved in such a way, he'll find it difficult, if not impossible, to interpret what he is being offered as genuine or real. In second case, where one has a significant backlog of hurt and disappointment in relationship, a person could easily come to believe that a genuine expression of love is extremely rare. All men are same. This common saying, that is going on nowadays in social media, is one of the example of the same, right? Or if I'll go a little bit political, okay, I won't go in that manner. It might be very, what I can say, it might come across very wrong way. So I don't want to give any controversial religious based statements over here. But you got the gist, right? If not non-existent, and would probably interpret the situation either as someone wanting something or trying to take advantage of him in some way. I'm sure that I don't have to go on and on, citing examples of all the possible ways there are to misinterpret what someone is trying to communicate to us, or how what we express to someone can be construed and experienced in ways completely unintended by us. The point that I'm making is that each individual will define, interpret, and consequently experience whatever information he is exposed to in his own unique way. There's no standardized way to experience what the environment may be offering, whether it's positive, negative, or neutral information, simply because there is no standardized mental work in which to perceive information. Very important. So, in case if you are not in trading, still you're here, then also you'll understand in the beginning why I said it is important from the psychological perspective, and it is going to give you a good, you know, perspective about the life as well, right? So, this is another example of the same. Consider that as traders, the market offers us something to perceive at each moment. In a sense, you would say that the market is communicating with us. If we start out with the premise that the market does not generate negatively charged information as an inherent characteristic of the way it exists, we can then ask and answer the question, what causes information to take on a negative quality? In other words, where exactly does the threat of pain come from? If it's not coming from the market, then it has to be coming from the way we define and interpret the available information. Defining and interpreting information is a function of what we assume we know or what we believe to be true. Hmm, very important. If what we know or believe is in fact true, and we wouldn't believe it if it weren't, then, when we project our beliefs out into some future moment as an expectation, we naturally expect to be right. When we expect to be right, any information that doesn't confirm our version of the truth automatically becomes threatening. In life, also, right? Not just in trading, in life, also. We, like most of the people, even the very well literate people, too, they're also doing the same. They just don't want to get proven wrong in any sense. Any information that has the potential to be threatening also has the potential to be blocked, distorted, or diminished in significance by our pain avoidance mechanism. If it's this particular characteristic of the way our mind function that can really do us a disservice. As traders, we can't afford to let our pain avoidance mechanism cut us off from what the market is communicating to us about what is available in the way of the next opportunity to get in, get out, add to, or subtract from a position just because it's doing something that we don't want or expect. For example, when you're watching a market, one you really, if ever, trade in with no intention of doing anything, do any of the up or down ticks cause you to feel angry, disappointment, frustrated, disillusional? Okay, delusional, or betrayed in any way? No, the reason is that there's nothing at stake. You're simply observing information that tells you where the market is at that moment. If the up and down ticks that are watching from form into some sort of behavior pattern you have learned to identify, don't you really recognize and acknowledge the patterns? Yes, for the same reason, there's nothing at stake because there is no expectation. You haven't projected what you believe, assume, or think you know about the market into some future moment. As a result, there's nothing to be either right about or wrong about. So the information had no potential to take on a threatening or negatively charged quality. With no particular expectation, you haven't placed any boundaries on how the market can express itself. Without any mental boundaries, you'll be making yourselves available to perceive everything you've learned about the nature of the ways in which the market moves. There's nothing for our pain avoidance mechanism to exclude, distort, or diminish from your awareness in order to protect you. In my workshop, I always ask participants to resolve the following primary trading paradox. In what way does a trader have to learn how to be rigid and flexible at the same time? The answer is, we have to be rigid in our rules and flexible in our expectation. Very, very, very important. Hmm. Let me add another slide. Let me add text box. NLP pack. Great. We need to be rigid in our rules so that we gain a sense of self trust that can and will always protect us in environment that has few, if any, boundaries. We need to be flexible in our expectations so we can perceive with the greatest degree of clarity and objectivity what the market is communicating to us from its perspective. At this point, it probably goes without saying that the typical trader does what is just opposite. He's flexible in his rules and rigid in his expectations. Right? Exactly true. True that. Been there, done that. So yeah. Now the answers that I am getting, now I have to work on that, right? And implement it. Interestingly enough, the more rigid the expectation, the more he has to either bend, violate, or break his rules in order to accommodate his unwillingness to give up what he wants in favor of what the market is offering. Important. Hmm. Eliminating the emotional risk. To eliminate the emotional risk of trading, you have to neutralize your expectation about what the market will or will not do at any given moment or in any given situation. You can do this by being willing to think about the market's perspective. Remember, the market is always communicating probabilities. At the collective level, your edge may look perfect in every aspect, but at the individual level, every trader who has the potential to act as a force on price movement can negate the positive outcome of that edge. To think in probabilities, you have to create a mental framework or mindset that is consistent with the underlying principle of a probabilistic environment. A probabilistic mindset pertaining to trading consists of five fundamental truths. Okay, this requires a new page altogether, man. I'll have to add another slide right here. Okay, let's go through these truths one by one. Anything can happen. You don't need to know what is going to happen next in order to make money. There is a random distribution between wins and losses for any given sets of variables that define an edge. An edge is nothing more than an indication of higher probability of one thing happening over another. Every moment in the market is unique. Now, if I'll go through these once again, so we'll get why these are very important, right? Okay, so the first one is anything can happen. You don't need to know what is going to happen next in order to make money. There is a random distribution between wins and losses for any given set of variables that define an edge. An edge is nothing more than an indication of higher probability of one thing happening over another. Every moment in the market is unique, right? So yeah, that's fair. Hmm. Now moving ahead, these are very important. Keep in mind that your potential to experience emotional pain comes from the way you define and interpret the information you are exposed to. When you adopt these five truths, your expectation will always be in line with the psychological realities of the market environment. With the appropriate expectation, you will eliminate your potential to define and interpret market information as either painful or threatening, and you thereby effectively neutralize the emotional risk of trading. The idea to create a carefree state of mind that completely accept the fact that there are always unknown forces operating in the market and everything is interrelated in one way or another, right? This can only make you profitable in a longer run, right? Otherwise you'll see some short winnings but you'll not succeed in a longer run. When you make these truths a fully functional part of your belief system, the rational part of your mind will defend these truths in the same way it defend any other belief you hold about the nature of trading. Like it will become the part of your belief system, right? So that's the core idea. That's what we are trying to do over here, making it a principle of your mind, like belief system. It's a part of your belief system. This means that, at least at the rational level, your mind will automatically defend against the idea or assumption that you can know for sure what will happen next. It's a contradiction to believe that each trade is a unique event with an uncertain outcome and random in relationship to any other trade made in the past. And at the same time, to believe you know for sure what will happen next and to expect to be right. If you really believe in an uncertain outcome, then you also have to expect that virtually anything can happen. Otherwise, the moment you let your mind hold onto the notion that you know, you stop taking all the known unknown variables into consideration. Your mind won't let you have it both ways. If you believe you know something, the moment is no longer unique. If the moment isn't unique, then everything is known or unknowable. That is, there is nothing not to know. However, the moment you stop factoring in what you don't or can't know about the situation instead of being available to perceive what the market is offering, you make yourself susceptible to all the typical trading errors. For example, if you really believed in an uncertain outcome, would you ever consider putting on a trade without defining your risk in advance? Hell no. Would you ever hesitate to cut a loss if you really believed you didn't know what about trading errors like jumping the gun? Would you anticipate a signal that hasn't manifested itself in the market? If you weren't convinced that you were going to miss out, why would you ever let a winning trade turn into loser or not have a systematic way of taking profits? If you weren't convinced the market was going our way indefinitely, why would you hesitate to take a trade or not put in put it on at all unless you were convinced that it was a loser when the market was at your original entry point? Why would you break your memory management rules by trading too large a position related to your equity or emotional tolerance to sustain a loss if you weren't positive that you had a sure thing? Finally, if you really believed in a random distribution between wins and losses, could you ever feel betrayed by the market? If you flipped a coin and guessed right, you wouldn't necessarily expect to be right on the next flip simply because you were right on the last, right? Nor would you expect to be wrong on the next flip if you were wrong on the last because you believe in a random distribution between the sequences of head and tails. Your expectation would be perfectly aligned with the reality of the situation. You'd certainly like to be right, and if you were, that would be great. But if you were wrong, then you would not feel betrayed by the flip because you know and accept that there are unknown variables at work that affect the outcome. Unknown means not something your rational thinking process can take into consideration in advance. As a result, there is a little, if any, potential to experience the kind of emotional pain that wells up when you feel betrayed. As a trader, when you're expecting a random outcome, you'll always be at least a little surprised at whatever the market does, even if it comes exactly to your definition of an edge and you end up with a winning trade. However, expecting a random outcome doesn't mean that you can't use your full reasoning and analytical abilities to project an outcome or that you can't guess what's going to happen next or have a hunch for or feeling about it because you can. Furthermore, you can be right in each instance. You just can't expect to be right. And if you're right, you can't expect that whatever you did that worked the last time will work again the next time, even though the situation may look, sound, or feel exactly the same. Anything that you are perceiving now in the market will never be exactly the same as some previous experiences that exist in your mental environment. But that doesn't mean that your mind, as a natural characteristics of the way it functions, won't try to make the two identical. There will be similarities between the now moment and something that you know from the past, but those similarities only give you something to work with by putting the odds of success in your favor. If you approach trading from the perspective that you don't know what will happen next, you will circumvent your mind's natural inclination to make the now moment identical to some earlier experiences. Hmm. As unnatural as it seems to do so, you can't let some previous experience, either negative or extremely positive, dictate your state of mind. If you, if you do, it will be very difficult, if not impossible, to perceive what the market is communicating from its perspective. When I put on a trade, all I expect is something will happen, regardless of how good I think my edge is. I expect nothing more than for the market to move or to express itself in some ways. However, there are some things that I do know for sure. I know that based on the market's past behavior, the odds of it moving in the direction of my trade are good or acceptable, at least in relationship to how much I am willing to spend to find out if it does. I also know before going in getting into a trade how much I am willing to let the market move against my position. There is always a point at which the odds of success are greatly diminished in relation to the profit potential. At that point, it's not worth spending any more money to find if the trade is going to work. If the market reaches the point, I know without any doubt, hesitation, or internal conflict that I will exit the trade. The loss doesn't create any emotional damage because I don't interpret the experience negatively. To me, losses are simply the cost of doing business or the amount of money I need to spend to make myself available for the winning trades. Important. If you'll start, behaving in this manner, then you will get success for sure. If you'll implement it in right manner, I'm very sure about it. If on the other hand, because I have been through this, and if I would have thought it in this manner, I would have gotten a greater success. I'm very sure about it. If on the other hand the trade turns out to be winner, in most cases I know for sure at what point I'm going to take my profits. If I don't know for sure, I certainly have a very good idea. The best trader are in the now moment because there is no stress. There's no stress because there's nothing at risk other than the amount of money they are willing to spend on a trade. They are not trying to be right or trying to avoid being wrong. Neither are they trying to prove anything. If and when the market tells them that their edge aren't working, or that if it's time to take profits, their mind do nothing to block this information. They completely accept what the market is offering and they wait for the next edge. Okay, so that's what we understood today, accepting the market as the way it is. All right, so by this, we are coming to the end of today's chapter. In case if you have any doubts, any worries, or anything, any piece of information that you want to share with me, or any suggestions that you want to give to me, yes, you can do it in the comment box right up. And in the next chapter, we are going to talk about working with our beliefs, working with your beliefs. Basically, this is the title of the chapter, but basically, we are going to talk about our beliefs, right? So, thank you so much if you have come so far. And I hope you have learned something from here. And thank you so much, universe. Thank you so much, Radha Ranji. We'll meet next time. Till then, stay happy, stay safe, and peace out.